Well, I think you're right. What we are seeing is clearly an increased elements of volatility hitting the market. And while our market indicators at the moment are clearly pointing towards some level of euphoria as end of last week, and therefore a correction might be very well possible. I think what will most likely happen is that volatility will clearly pick up. Data on the COVID side are clearly very high, and we are seeing some level of discrepancies between with the development of the vaccination programs in some of the largest countries and what's going on in emerging markets, and that could potentially cause a difference in terms of speed of the recovery on a global basis.
Are investors, and I noticed your comments about ETF inflows into equities, et cetera, are investors being paid enough money for the risks they're taking on, given, let's be honest about it, pretty sky-high ratios and valuations compared to history?
Well, if you look at in terms of the flow, in terms of the equity ETFs, we have seen a significant flow in terms of the overall asset class. But what we have not seen yet is a reallocation in terms of different geographies. European equities, for example, are still relatively cheap. And we know that by the end of the year, the GDP growth in the EU zone will clearly outgrow what is currently going on in the US. Emerging markets still a big bet exactly for what we just said in terms of the COVID and the uncertainty related to the earnings growth that we might potentially see. China, different story. Significant flows both on the equity and the fixed income side, also because of the change in benchmark and the inclusion of Chinese bond into some of the largest benchmarks before the end of the year. But clearly, there are some bets that are open in terms of the recovery in the Chinese market and the growth that is underlying that economy.
Yeah, but there are some problems, aren't there, Matteo? And we need to wait to see whether that GDP growth actually gets delivered through the rest of this year for the Eurozone. But it's clear that these markets are a little cheaper for good reason. They just don't have the same growth momentum or dynamic that we've seen in the United States over recent weeks and months here. Let me throw in just one more caveat at this point. If you look at the ECB data on loan growth, it's going in the wrong direction. So what's happening here in Europe? Because even as you talk about higher growth and the opportunity around valuation, some of the macro metrics just don't seem to add up when we look at the credit impetus.
It is that clearly, but and it's also different speeds at which the different European economies have been opened. Germany, in fact, is still relatively closed. The fact that some of the countries have imposed now additional restriction from international travel of the UK will clearly wait in terms of a potential delay of the recovery of what was seen to be a very strong recovery in the UK market. What we really should look at it is like which sectors could provide two things. One, relatively edge in terms of the inflation, because we know that inflation is going to be a problem eventually by the end of the year, eventually in 2022. And there are already signs of that, not only in the US, but also internationally. And second, the volatility that is driven by news flow. Let's remember that what we have just experienced during this weekend in France is really the appetizer of what could be a very potential volatile September with the German election. The German election are going to be the event of a generation, with Merkel really changing the overall landscape in Germany. And some of the new forces could potentially be, even if the Merkel coalition is 8 points ahead during the weekend in terms of polling, could potentially really change some of the balances of power in the largest economy in Europe.